Group of companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Welcome to Market Masters. This is our second edition of our flagship show where you meet the best talent at Dalal Street during 2024. My name is Shail Bhatnagar and with me is my colleague Sakshi Batra. Today you're going to meet a man who's well versed with the art of valuations, both long and short. A man who is absolutely at home allocating capital, and a man who's seen Indian markets since Sensex was sub 2000. It is about 72,000 now. Ladies and gentlemen, please meet Vetri Subramaniam. He's the CEO of UTI Asset Management for the last 7 years, and Vetri over the last 31 years has spent time with Invesco Asset Management Company. He spent time with Motilal Oswal Securities, has had 2 stints with Kotak, and of course I know him since his stance in SSKI Securities from 1990. A very warm welcome to you, Vetri, and it's such a pleasure to host you for the first time in 2024.
Delighted to be here, Shailendra and Sakshi. It's been a while since I've been on this platform, so I'm happy we can, pick up the conversation again.
Okay, let's start as quickly as possible, Vetri. And since, as I had said, you are so good at valuations, let's start with the Nifty. We've had a record high all through December and, of course, a bit of a profit taking now. How do you see the Nifty and the overall valuation space of the Indian markets in relation to its global peers? Are we overvalued? Are we in the right zone? What do you feel when you see Nifty on a daily basis? Do you have a feeling of quiet comfort, or is it getting edgy at current levels?
Sure, good question, Shailendra. And when we look at the Nifty, and let's say specifically the Nifty 50, what we are really looking at is large cap valuations. Internally, Shailendra, we run a model which looks at Nifty valuations relative to its past history. This is on price to earnings, price to book, as well as dividend yield. And then we also run a cross asset comparison, which is to say, what does the 10-year bond yield look like compared to the attractiveness of the Nifty 50, where we essentially look at the earnings yield. And earnings yield is nothing but 100 divided by the forward PE multiple of the Nifty. Now, that is the model that we use, all these 4 factors together to give us an idea of where we stand in the valuation cycle. I would say when we look at all these parameters put together, that we are in the positive zone, but closer to neutral. So, if our asset allocation model can throw up an allocation anywhere between 30 to 90% to equities, it's currently pointing just slightly above 50% equities based on Nifty 50 valuations. So, if you ask me about valuation comfort in the market, I would say neutral to slightly positive as far as the large caps are concerned. However, where our discomfort, and that's the word I would use as regards valuations, is really to do with the mid caps and small caps, because over there the valuations are actually closer to expensive rather than being in the fair value zone.
Okay, let me just take this argument a little forward. Vetri, we have somewhere like, let's just say 21,600 on the Nifty. Would you just guess the level on the Nifty if all goes well by December 2024?
Shailendra, I always say that I'm not in the business of forecasting. We are in the business of managing the money with us, positioning it in where we think the best companies can deliver outcomes. So, forecasting the Nifty outlook 1 year down the road is, to my mind, not integral to our role as being fund managers. We don't have a forecast. We don't work with forecasts of the Nifty.
Okay, let me just put this in perspective. Vetri heads UTI Asset Management Company, which offers 65 schemes to Indians as well as NRIs. Of this, the funds under management are somewhere like 2,75,000 crores, of which a large majority is in equity, somewhere like 2 lakh crore rupees. And for all those old timers in the market, UTI is the pioneer of India's mutual fund industry. It started with the US 64 way back in 1964. But coming to third quarter earnings expectations, Vetri, where do you see outperformance? Where do you see calmness in the market? And where is fresh money getting deployed?
Sure. Good question. So, I'll take the last part first because, to our mind, where you find attractiveness in the market is more a function of where you find valuation comfort. And if I were to look at valuation comfort, I would say our large valuation comfort actually is with the financial services sector. Specifically, I would say the core lending institutions. So that would be one area where we think there's valuation comfort. This is an unusual sector in which metrics in terms of financials have actually improved over the course of a year, but valuations have actually gone south over the course of a year. So to our mind, core lending institutions and financial services is really the most attractive part of the market today. If I were to point to two other areas which we find reasonably attractive, though valuations have moved higher over the course of the last year, one would be healthcare, and second would be automobiles. Both these sectors did very well, unlike banking over the last 1 year relative to the Nifty. Both these sectors actually outperformed the Nifty over the last 1 year. But these are two areas where we think we still have some comfort just looking at valuations and the potential growth that lies ahead. So these would be sort of our preferred areas where we think additional money can get deployed for those looking to benefit from the sort of beta play which is always available at a sectoral level. As regards earnings, Shailendra, I think the broad story is going to be continue to be one of sort of weak top line growth, certainly in the consumption area, slightly better top line growth in the investment cycle related businesses. But even there, we suspect on a quarterly basis, you may actually see a little bit of easing of momentum. The overall early indications that we have from a range of businesses has been that the festival quarter and the end of the year leading into December was slightly soft. But from a margin perspective, I think things will hold out. So you should expect profit growth, particularly operating profit, to be much superior to actual underlying top line growth.
Okay. Vetri, good afternoon to you. I will begin asking you some of the viewer questions that we have, which are very, very important at this point in time as well. When we talk about the strategies for 2024, a lot of investors holding on to cash are looking to where exactly should they be deploying their money. So the first question, in fact, there are two questions which are related and I will take them back to back. The first one is from Kuldeep Singhal. He wants to know what kind of stocks will attract interest this year? Will there be more focus on mega caps? And second of all, which is also related to this, and perhaps you can address both these questions at one time. This is from Tia Kapoor from Nagpur. She wants to know what should be the strategy for mid and the small caps then?
Sure. So as you know, we don't give stock records, but as I said in my opening comments, the part of the market where we would be more comfortable deploying capital would be in the large caps, the mega caps, if you choose to call them that. So just in terms of relative preference, large caps well above mid and small caps. That's really the preferred area where we would look to invest capital. I would also recommend that for investors who are looking to deploy money in lump sums, strategies like the balanced advantage fund and the multi-asset allocation funds are good strategies to consider, because in these strategies, the actual net allocation to equity is a function of valuation. So, you can sort of make a large investment into the scheme, but in the background, the equity allocation may be only 50%. And if for whatever reasons the market were to get cheaper in terms of equity valuations, automatically the equity allocation allocation in the strategy would rise. So for those who are looking to make a lump sum allocation, we would recommend these two strategies as ones where the equity allocation is dynamically managed to the advantage of the investor. So I think that's really where the preference would lie. As far as mid and small caps are concerned, as I said earlier, this is an area where our valuation comfort is much lower. I would recommend, and it's hard to know what each investor's individual positioning is, but if relative to your investment goals and related to the starting point that you had for mid and small cap allocation, you are now overly exposed to them because obviously that area has done far better, it's been rewarding for you in the last 2 to 3 years, then this is a time to take your exposure back to where your original framework said your allocation should be. So that's really what we would recommend. In general, I write a monthly commentary, and my commentary this month, if I were to sum it up in one word, the recommendation to all investors is rebalance. Rebalance because equities have done well, within the mid and small cap has done well. So whatever your starting guideposts were for allocation, this is a good time to reallocate and rebalance your portfolios.
Okay. Vetri, let's just address two broader themes as far as 2024 and 2025 are concerned. One, we've seen a very, very heavy inflow of 55,000 crore rupees in the month of December from our foreign friends as far as domestic markets are concerned. And in 2024, we will also see India getting included in the JP Morgan Global Bond Index segment. When you put in your thinking cap at potential inflows for 2024 and 25 from overseas, what is the kind of number that's coming up on your radar?
So first of all, nobody telegraphs that number to you, Shailendra. So it's a pointless discussion. If I were to stack things in order of their difficulty, I would say forecasting the market is difficult. That's why I've stopped doing it. Maybe I tried it early in my career. If you actually ask me what is even more difficult than forecasting the market, it's actually how the money will flow. Right. So that's one level of difficulty, even higher than forecasting how money will flow. Now, thankfully, in India, because of the SIP, we do have some visibility. 15 to 16,000 crores is coming in through that SIP pipeline, as is reported by AMFI. But let me just shift your attention a little. Why so much discussion about only where the money will come from? Please look at the other side, where the supply is coming from. And by the way, I never think people should look at capital markets as a demand supply issue. If you want your economy to grow, you need entrepreneurs to be able to access capital. And if you want your economy to grow on the other side, because it takes two hands to clap, you need investors handing over their savings to entrepreneurs and thereby allowing the economy to invest and grow. So these are simply two sides of the equation which have to always be balanced for growth. It is not a question of there is more money than there is supply and therefore, prices should go explosive. That's not the reason why capital markets exist in the first place. Having said that, it's very interesting to look at the numbers, because if you look at the IPO pipeline,
Yes.
not the IPO pipeline, but the actual IPO issuance which happened in 2023, you add to that the QIPs, the OFS, multiple formal routes of wealth through which equity issuances happened, primary or secondary. And then you add to that all the block deals, right? Because many of these block deals happened from PE funds and venture capital funds looking to exit their stakes in the secondary market. There was more than 2.5 lakh crores of supply, right? So why only talk about where the demand is coming from? For this economy to grow, there will have to be supply, there will have to be demand, and that's how we will actually get that going. Now, as far as foreign money is concerned, I would just say that all asset allocators have certain structural views. I think from a structural point of view, India will always be a preferred market, but valuations also matter. So I would still say that in a global context, when we talk to asset allocators, structurally positive about India, but not so keen about deploying money in the short term because of valuations. And remember, when you look at the global landscape, Shailendra, honestly, the Nasdaq was up 55% last year, right? That's a 15-20 trillion dollar market going up that much. And then you've got markets like Japan, which were up 30%, Mexico in dollar terms up 25-30%, Brazil up 20%. So there are many options for global asset allocators. I think India will remain the structural buy, but on a year-to-year basis, valuations do matter to the allocators.
Let me just rephrase this question differently. Over the last 6 months or close to 8 months, Vetri, we've seen a slew of very, very positive macro and micro reports coming on this island of safety that probably India is at this moment. And the kind of structural growth shifts that we are seeing, whether it is because of aspirational part of the economy, whether it is about money getting deployed regularly into markets, so on and so forth. What, according to you, are the three main structural tailwinds which will continue in 2024 and 25?
Sure. So I'll answer this in two different ways. I think, when you look at the Indian economy, there are, I think, four things that I would point to which give us a very good platform for sustaining growth over the medium to long term. One is that the health of domestic corporate balance corporate balance sheets in India is very good. Add to that the fact that bank balance sheets are the healthiest in almost 20 years. So effectively, from the financial side of things, both your bank balance sheets and your company balance sheets are both in very good shape. This is a great enabling factor that you would want to have. The second thing, or rather the third and the fourth thing, which I think put India in good light, is one, we have returned to the path of fiscal discipline. Just like every other country, the fiscal deficit sort of ballooned due to the pandemic in 2020. But I think we've been faster than other economies and sort of reiterated the target of continuously guiding down the fiscal deficit. Remember, this year's target 5.9, 2026, the government has talked about getting back to 4.5, still above the pre-pandemic level. But in a global context, this would still qualify as a slightly conservatively managed fiscal. And that's important to global investors, or for that matter, any investor. The other point, again, would be monetary policy. We have not been as profligate as many of particularly the Western central banks in terms of pumping liquidity. Therefore, we do have some dry powder and we've managed our monetary affairs well. So I would say it's these four factors put together which really give us a solid growth platform, which is a sustainable growth platform. The one point that I would make over here, Shailendra, and this is always important to understand, on the one hand, you have a strong platform, but what sits on that platform is the burden of expectations. The higher stock prices go, the higher valuations go, the burden of expectations tends to go higher and higher, which means the market is already implying terms of growth, and any disappointment to that higher expectation of growth, we're not discussing the strength of the fundamentals, those are a given, as I told you, but the higher burden of expectations makes markets riskier inherently, simply because you're now dealing with expectations, you're not discussing the underlying fundamentals. And that's the thing that I would point out to viewers. Economy is great, but valuations equal expectations. The more valuations go higher, more the burden of expectations. Even a single grain of sand which then lands on top of that can then cause some bit of upheaval in the marketplace. And that's why it, some of our asset allocation models are suggesting what they are in terms of their allocation to equities.
Okay. Vetri, at this point, I think I'll take one more question from our viewers. This is from Bengaluru, and Nikhil Parihar wants to know from you which sectors are likely to outperform in 2024 and which are the ones that are likely to underperform in 2024.
Well, I hope I partly answered that, though I would say my answer is only about where do I have valuation comfort. From having valuation comfort to knowing what will do well over the next 12 months, these are two very different things. And I don't claim to have any skill about the second part. My, skill set, if I can call it that, is only about ascertaining where the valuations back me to take risk at this point of time. As I said, financials is one area we like, pharma, healthcare, and automobile more mid-cycle, but that's an area we like. So what are the areas that we feel slightly more circumspect about, where we think valuations have possibly run ahead of what those companies can deliver in the mid to long term? Certainly, I would call out capital goods over there. I think the near-term prospects will remain good. It may be even better than what it is for consumption, but the burden of expectations over there now is fairly high. So we do worry a little bit about some of the valuations in capital goods and also in utilities, because utilities are primarily a fixed return business. They operate on fixed ROE models. You can't bump up their valuations beyond a point of time, irrespective of the fact that there may be short supply, because very few companies get the benefit of those higher profitability. So these are two, and it takes a very long time for new supply to come on stream. So these are the two areas where we think the valuations suggest a slightly more guarded approach going into 2024, capital goods and utilities.
Okay. I hope, Nikhil, that answers your question. One more question I will take from our viewers list is from Sakshi Rathore from New Delhi. She wants to know from you how to identify good companies ahead of time. And I think this is a valid question, Vetri, because, the market's already at record high levels. To pick up stocks which have already run up so fast and so sharply in a short period of time will be even more challenging. So how does one go about stock picking in 2024?
I don't think it's a question of how to go about in 2024. I can only share what I think has worked for me personally over many, many years. One is that what you eventually want to buy is a sound business. Don't for a minute forget that just because of all the excitement that you see on screens such as these about stock prices, that you are doing something which is not related to the business. So eventually you want to buy a sound business. My, two-factor model to understand what is a good business. A, it should throw up operating cash flow. Second, it should have a return on capital that is higher than cost of capital. Nobody can run a business if it does not convert profit operating cash flow, and if it does not convert the reinvested capital in the business at a rate of return higher than cost of capital. So any business has to meet these two simple tests. The only other point that I would add on top of this, because I tend to have a bit of a value streak, I want to buy a good company and a good business, but I love to buy them when the market has started to turn slightly tired about them, it has derated them, or maybe the company is going through some issues which to my mind are more short-term in nature. They don't change the long-term picture. So that's the third element of what drives my investment philosophy. A good business, good operating cash flow, good return on capital, but B, don't buy it when everything is going hunky-dory. Try and look for that time when things or the market has a slightly jaundiced view about the future of the business. And if your view has not changed, that actually creates the valuation opportunity in your favor.
Okay. Vetri, let's analyze this particular equation on both sides. UTI AMC, as is a host of other AMCs, are blessed these days in receiving something like 17,000, 18,000 crore rupees a month via SIPs. So buying such businesses is not a problem. The problem is, are such businesses available at this point of time in the segment that you mentioned, derated, jaundiced view, markets are tired about the companies. Are there some on your radar as of now?
Yeah, as I said, certainly core lending institutions and financials sit very well over there. India is underpenetrated in terms of retail credit. I think the banks have significantly consolidated in favor of the top 5 or 6 banks, which now have, 2/3 market share of deposits and lending. And finally, if you do see momentum on the capex part of the economy, at some point of time, corporate credit will also start to contribute to growth. So certainly, to my mind, the lack of performance by financial services and banks in the last 1 year has created that opportunity where you can get good businesses at reasonably attractive valuations. I talked about utilities earlier. Those were predominantly power utilities where we feel a lot of the good news is in the price and in the valuation and fundamentals. But if on the other hand, I look at some of the gas-based utilities, We actually think over there is a much more interesting opportunity. The stocks have done nothing. They've derated. There have been issues related to the availability of natural gas. But we think some of these will get addressed in the medium to the long term. And therefore, these valuations actually are offering you a reasonable opportunity over there, basically in gas-based utilities.
Absolutely. So if you are intelligent and commonsensical enough, you can easily find these gas-based utilities on the markets. I'm sure Vetri will not mention names, but he's pretty much checked all boxes. The rest is a bit of sleuthing on your part. Vetri, just as both of us started our careers, there was a time when PSUs were blue chips, and somewhere in the middle to late 2008 onwards, till about 2 years ago, they lost momentum. Some of those stocks corrected 90-95% from their peak, but are now on their way up. What has changed as far as PSUs are concerned? And in this valuation matrix that you talk about, which is a tired market, a jaundiced view, are some PSUs still in that segment where you might want to deploy fresh capital?
A good question, Shailendra. First of all, I would say, because PSUs operate in different segments, I don't like to take a thematic view in terms of saying all PSUs are good or all PSUs are bad. To my mind, it comes down to saying in every business and every sector that you invest in, what are the opportunities available to you, or which are the companies which have the best fundamentals, which allow them to grow in a sustainable fashion, and where the valuations are attractive. So I don't have a generic answer for you in terms of PSUs. I would say take a call at a stock level. In fact, I would say taking a call at this thematic ownership level is in fact perhaps something that could be dangerous in terms of the level of risk you're exposing yourself to, because in many sectors you actually have far better alternatives in terms of sustainable businesses which are running in the private sector. And again, as I said, I'm ownership indifferent. It's a question of which company has the best competitive franchise in the industry in which it operates. If it happens to be a PSU, we're happy to back it. If it's not a PSU, then we would rather not back it. Using the owner filter, I think, would lead to wrong decisions.
But do you think, when you're talking about these PSUs at large, we've seen several of the subsectors outperform, maybe, come out as dark horses in 2023, defense, railways, the power utilities as well. And of course, the PSU banks that have had a stupendous run up. Many people, viewers, would be feeling a FOMO at this stage, because every time a caution is warranted, we do see another 5-10% of a move on these PSUs on an everyday basis as well. So what would you advise them? I mean, is it too late to enter these pockets, and how should one go about these pockets then? Because FOMO is definitely that they're facing.
Well, you've put your finger on the problem there, Sakshi. FOMO is not the kind of thought process you want to bring to the stock market, right? I mean, if FOMO is the process you bring to the stock market, you've compromised your own investment outcomes over a long period of time. So I would just say stick to, the goalpost that you started out with rather than FOMO. And, the benchmark for FOMO has got to be much higher. It's not 5% and 10%. If you think a stock can make 300% or 500 or 1000%, over the next 5 years, 10 years, 15 years, then you should start thinking about, should I reevaluate this business? There's always a good reason to reevaluate every business at a point of time. But, it's not about 5% and 10% moves. That's not what gets me excited in equities.
Okay. The one sector that we haven't spoken of so far in the last half an hour or so is the IT sector, where all the eyes will be in the next few days when the earnings season kick-starts. This has been an underperforming sector of 2023. But how are you really positioned here? What is your own sense? Large cap IT versus mid caps, which have had a rather better run. How should one be looking at these two pockets?
Interesting question, Sakshi. Actually, CY23, IT did better than the Nifty. And largely it was a function of, I think, November, December being very good for IT. But yeah, I mean, if you look back to where the IT companies were, maybe all the way to October, November 21, right? So more than 2 years ago, most IT companies are still below those peaks, right? Whereas the market is above that peak. So over a 2-year basis, you're absolutely right. IT has underperformed. To my mind, IT remains a sort of buy on dip sector. Look, it's very hard to find sectors in which Indian companies are globally competitive. This is one. These companies are tried and tested and forged through very difficult periods over the last 20, 25 years. I've seen them, start of my career where these companies had turnovers of less than 100 crores, and look at the multi-billion dollar sizes they've
Absolutely.
achieved. So I would back these companies at the right price as the right valuation. To my mind, this is still more a sort of buy the dips rather than chase the recent run up in prices sector.
Okay, and you make me fondly remember the kind of growth that Infosys used to show in 96, 97, 98. It's actually 100% year on year and repeatedly, followed by 1:1 bonus, 1:1 bonus, then
Wow.
bonus.
That
So
was the time to be in IT, I believe.
now is the time to be in all these wonderful internet companies. So
Well, actually, Sakshi, not fully true. Even if you look at the last 10 years, 15 years, IT
yes,
has always created value. And it's created value for a very simple reason. Those businesses generate cash flow,
yes,
they have a high return on capital. And in the last 7 years, they've finally learned that if you don't have a use for the capital, return it to the
right.
shareholder either by doing buybacks or by dividending. So I
Yeah.
think that was the piece of the equation they've missed. But on a 10 to 15-year basis, IT has actually been a net value creator.
Absolutely.
Wonderful.
And it's actually one more interesting thought I'd like to mention here, that if you look at the long-term performance of a lot of mutual funds, in terms of sectoral play, it's the IT funds that have outperformed the Nifty, the equity market funds, the diversified set by a huge, huge margin.
Sure.
And that's mainly because of this debt-free, huge cash generation, and now they are buying back stocks like there's no tomorrow, simply because they're sitting on so much of cash. Two segments, Vetri, that have opened up in front of us in the last 3 years has been this internet play. We have global sized companies in India which are near monopolies, whether you look at food distribution, whether you look at insurance plays, whether you look at payment gateways. These are absolutely global companies. The only thing that went wrong was the entrepreneur pricing the IPO. Now, how do you see it in the valuation metrics that you have at UTI AMC and in your mind when you look at these newly minted companies with the global, how should I say, outlooks and an ambition to match them?
Uh, Shailendra, interestingly, we launched a scheme in October 2023, which is the UTI Innovation Fund. Now, of course, it looks beyond the traditional e-commerce space, if I can call e-commerce traditional, but it looks beyond e-commerce and direct to consumer businesses, because it also looks across areas like companies which are involved in global R&D, companies which are involved in the shifting of production bases, companies that are involved very crucially both in terms of the fossil fuel transition as well as clean energy transition that the world is going through today. So it's themed on innovation, but obviously a big part of it is sort of businesses which are direct to consumer. They are intermediating between a host of buyers on one side and sellers on the other side, and they are creating productivity gains. And these productivity gains are being shared between consumers, producers, and the platform itself. So it's an area we like. The businesses are still evolving. I think many of the entrepreneurs have had to readjust from a period of hyper focus on growth to saying, how do we make the businesses sustainable in terms of profitability? We still don't like business models that are burning capital, but if the companies have managed to get to a point where they are no longer burning capital, we think the operating leverage in these businesses is phenomenal. So we're not too worried about the lack of reported net profit as long as you have prevented further capital burn from happening. This is going to be a volatile space, Shailendra, but I think, themes like the innovation fund, we've been telling people, because of the 4 areas that it invests in: R&D, direct to consumer, internet commerce, climate change, fossil fuel change, steady investments through an SIP route is the best way to go. And we think many of these businesses will end up becoming, dominant in the Indian marketplace over the next 5 to 10 years.
Okay, Vetri, just to build on the same point, there are a slew of new unicorn IPOs that are slated to come out in 2024 as well. And we are again seeing valuations mark up on some of them, like Swiggy, Ola Electric, Oyo, again happening. Are we going to see a repeat of the problem that we faced in 2020, 2021, when huge valuations that they had come with, and then of course in 2022, they all had to face markdowns of valuations, and of course investors, early investors of IPOs who got the allotment are still to recover all of their money in the IPOs that have already been listed for 2 years now.
Well, I honestly, don't see this as a problem in the way that you're defining it, right? This is the capital market. It's full of adults. People are making certain disclosures, offering you a share. It's up to you whether you choose to buy it or not. I think looking at the IPO as a get rich quick scheme, that I'll invest in the IPO, sell on listing, oh, I didn't get to make that gain. Well, I think then there is a problem with which how you are, approaching this whole investing issue. So, look, the market's always going to have volatile prices. Even the secondary market has volatile prices. I could point to very good companies which are down over the last 3 years in the secondary market, nothing to do with IPOs. And there are the other companies which are up tremendously in the secondary market over the last 3 years. Now, does that mean somebody who sold that company 3 years ago should feel aggrieved that he sold it? The answer is no. Everybody is taking a decision based on the facts available to them. So, this is just the nature of the beast. Greed and fear cannot be removed from the market, and you have to figure out what's the thought set with, mindset with which I'm going to tackle investing, because greed and fear exist. So, I think it's more about each one of us overcoming our own mental models rather than making this out to be some kind of a market related problem.
Okay, so in the 31 years that you've been in the markets, Vetri, and the fact that you mentioned with a lot of emphasis the burden of expectations that sits on top of us in the next couple of years, what is your mental makeup? How do you sort of, when you address your fund managers, what is it that you tell them not to look to? We know the positives.
Sure. Well, I think is just the first point would be to go back to what I said is the core of our investment process, and that underpins the way I think about companies. I really care for companies that have to burn too much capital to grow, right? I mean, accounting losses for a while because the operating leverage is going to kick in down the road is something I can tolerate. But if you're still having to sell something below variable cost, right, to a consumer, because without that they're not willing to do business with you, then we don't like it, just to simplify things, right? So we want companies that are able to create profits and return on capital higher than cost of capital. Yeah, there could be a timeline of some company being able to achieve this 3 years down the road or 5 years down the road, but eventually there has to be a path to profitability which is clear. The second thing, when you talked about burden of expectations, is just to be aware that eventually cycles exist, changes will happen, and therefore you've always got to be careful about overpaying for businesses which appear to have great growth prospects at this point of time. We discussed IT. Look at where the IT valuations were in 2021, when people thought those kind of growth rates would persist all the way till eternity, and then they didn't, and therefore the stock prices have done nothing. So you also have to worry about overpaying for good businesses, and how do you manage portfolio risk in that kind of a context. And I think two of the things which are less understood by investors, and particularly within the investing team we try to be aware of this, is that where are the alternatives available to you in a portfolio context, and secondly, can you use portfolio sizing to manage risk better, right? I mean, maybe you don't need to have a binary decision of own the company, not own the company, but you can readjust your ownership level of the company in your portfolio to manage the kind of valuation risk that we are talking about and rebalance within your portfolio. So, as I would talk to retail investors, I talk to my own fund managers, that look for the rebalancing opportunity within your own portfolio, where something may be overextended and something may actually be more attractive in terms of valuations.
Okay. Vetri, my last question on the interview will be on, the next big event that we are watching out for, interim budget 2024, vote on account. What are your expectations? Should markets have any high expectations this time around or not? Because the previous time around, the markets thought that it's interim budget, but it almost came as a full-fledged budget. Do we expect a repeat of that? And after that, do we see another leg of the rally upwards for the markets? And where?
The last time I thought budget was really important. I didn't have as much gray hair. I may have been talking to Shailendra at that point of time. Look, over time, there is very little which happens in the budget which is material, right? I mean, you've moved the entire indirect taxes regime out of the budget. It's gone into the GST Council. It has nothing to do with the budget anymore. You have a trajectory in terms of fiscal deficit that you have, articulated. And the good thing is the government's been sticking to that. So, where is the room to do anything very, very material to really change the course of markets at any point of time? So, to my mind, if I were to ask anybody on this show, do you remember what happened in the 2018 budget, which completely changed the context of investing thereafter? Most people wouldn't even remember what happened in the 2017 or 18 or 16 budget, because, budgets come and budgets go, but it doesn't really change the way that you invest beyond a point. And the most material budgets happened in the decade of the last decade of the 1990s, right? Liberalization and thereafter, where we saw very dramatic changes being rolled out in the budget. But I don't think in the last 10 years I can point to anything being so material.
Okay, 4th July 1991, Sakshi, that was when Finance Minister Manmohan Singh just came to the parliament and said, now, the licensing Raj is dead and India is getting liberalized. So there was an India before 4th July 1991, and there is this India which is completely unrecognizable as of now. Vetri, a couple of last questions. 2 wars in 2023, and the fact that the world's second largest spender of defense, which is India, is now focusing inwardly to buy a lot of its defense needs. That's unleashed a rally on counters within this space, which is almost, how should I say, biblical in many ways. Do you get worried when you see such valuations and prices?
To the extent that these are eventually fairly cyclical businesses, it is a little bit of a concern. These are not businesses which typically have the best, sort of cash flow metrics and return on capital metrics. But again, I don't want to generalize. I do think that in this area, once again, the valuations have removed, some of the easy money. I wish we owned more of defense 2 years ago. It's something we didn't see playing out as large as it had. I'd certainly put it in my misses column for, 2023. But I do have concerns about where those valuations are today. I was just looking at some of the data the NSE puts out, and it was very strange to see the Nifty Defense Index actually trade at a premium to the Nifty Consumption Index, because for long we always thought, Nifty consumption is sort of the benchmark for things getting expensive, but it's strange to see a project-based business which has a lot more capital intensive actually get valuations which are at a premium to the Nifty consumption.
With that, Vetri, the last question comes from our side, which is what advice would the Vetri of today give to the Vetri of 1996?
Well, what I always tell people is, you need to have a plan and you need to stick to it. I think one of the lessons that I learned in the 90s, early in my career, I thought I could be 100% equity. But, all it took was one massive upsurge followed by a massive bear market for me to realize that to meet my financial goals, to take care of my family, to not expose anybody to undue risk, I needed a portfolio structure that was more balanced. It looks wonderful to look at the market today over the last 5 years and say, I can absorb drawdowns, I'm 100% equity. But I've written about this, it's in public domain, my own experiences in 99, 2000 about being 100% equity and then really having to take a massive, sort of setback in terms of the way that I looked at it. And I wouldn't want to put anybody through that experience. So, do look up, it's in public domain, I've written about it.
Okay. It's been a pleasurable 45 minutes, Vetri. Thank you so much for your time. And with such wonderful insights, it was such a wonderful experience listening to such a balanced head on such wonderful shoulders. Thank you again. And
thank you.
we hope.
Thank you, Shailendra. Delighted to be on this platform after a long time and look forward to more such engaging conversations in the future as well.
Okay. With that, we thank you and you wish you the best for 2024. May the rally continue.
Cheers.
That, ladies and gentlemen, was Vetri Subramaniam. He is the Chief Investment Officer at UTI Asset Management. He runs 2,75,000 crores over 65 funds, and we hope you enjoyed this conversation as much as Sakshi and I did, as far as markets are concerned, where valuations are above board, where it makes sense to put in money, and what would you do with your capital at this point of time. Thank you for watching. Remain glued to Business Today Television.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today.
Mayuresh, your thoughts on Nestle? We are seeing this price for the very first time today, and after a long time, this